Woo! We are back. Here we go. True North, the investment grade Bitcoin podcast, episode 29. We are grooving. We are bringing the vibes back, and we are cooking. We've got a crew here tonight. We've got myself, Neethu, Adrian, and Dan. We are going to get into it. We've got so much data. This is going to be a jam-packed episode. We've got a ton of information, a ton of data, a ton of things have happened in the last week. We're going to try to get through as much information as we can. We're going to talk about MSTR leverage update, STRD, the IPO. We've got new capital coming into Bitcoin on the horizon that hasn't been announced yet. Quadruple threat ATM with MSTR, which has never been done before. Bitcoin treasury company update. We'll just talk broadly about Bitcoin treasury companies. Just given how much data we have, I think we'll keep that relatively minimal. And, you know, the rest of the community is doing a great and absolutely fantastic job talking about all of the other Bitcoin treasury companies. MetaPlanet and the Smarter Web Company, Alt BG, the one in Europe, all of those things. Everybody's doing great content, so keep it up. We'll also get into the STRF, STRK, STRD. We'll talk about credit spreads a little bit. PEG ratios, price earning to growth ratios, and MAG 7, and just compare those at scale. And we'll do some projections into 2035. We'll get a little into the moon math, which will be a good time. We'll talk about S&P 500 tracker, market bewilderment, estimated earnings for a Q2, just based on where we're at and what's on the horizon. We can do a little testing back and forth and see what kind of thresholds we're looking at, and just talk about the fixed income market in general. So I've got enough content and data that I could talk through an entire 2-hour episode by myself, but I've got the guys here on the screen to help keep me honest and bring in other data and information too, and give additional perspective. So for those that are listening, and if you haven't listened before, True North or the Investment Grade Bitcoin podcast, we talk about everything that's on the horizon with MSTR, Bitcoin equities, and how the financial landscape is changing. Our goal is to unpack these really complex topics into digestible pieces of information with data and analysis behind the scenes. So we are rogue. We are following this a little bit more closely than the traditional financial world. Most analysts, when they look at MSTR or they look at these Bitcoin treasury companies, they are completely missing the entire story here. So before we get into some of the data information, we've got a quick message from Tim.
Ladies and gentlemen, what you're about to hear may be amazing, but it is not financial advice. It's for informational and educational purposes only. Jeff, back to you.
Awesome. Thanks, Tim. And Tim runs the Bitcoin Treasuries podcast, and he helps bring the voice of all the people that are running all of these different companies that are adding Bitcoin to their balance sheet, and how the market is changing, moving. And go watch Tim's podcast if you haven't already. Okay, so that's the intro. We got through there, and shall we start with a leverage update, and we'll just jump right into the data and get into it, because I don't think we should waste any time. You guys cool with that?
Yeah, let's do it.
Cool. All right. So here we go. Back to sharing my screen. All right. We show this every week. And the point of this is to show MSTR's leverage, right? Because every day you will see a post on Twitter saying that MSTR is over leveraged, or MSTR is they're just doing something incredibly risky. They've got so much leverage on their balance sheet. They're taking on so much debt to buy Bitcoin. And the purpose of showing this and tracking this over time is to show it's actually not that much debt. The leverage ratio is actually incredibly low. So over in these two columns here, AS and AT, we've been tracking this for quite a while now. As of today, so Bitcoin strategy holds 582,000 Bitcoin. The price of Bitcoin is around $108,000. So assets held on balance sheet is 62.8 billion. The amount of debt that they have is 8.2 billion. The amount of preferred stock with a recent issuance is 3.2 billion. So net capital sitting on balance sheet is 51.3 billion. So the liability to asset ratio, so their leverage ratio is about 18%, which is incredibly low. Many of the other companies in the entire S&P 500 have leverage ratios 60, 70, 80, 90, some even greater than 100, because they are, betting on future performance of the company. So when you see the commentary that MSTR is overlevered, you could actually just look at the data and say, and you can look on Strategy's website, and it shows you how much assets they have and how much debt they have, and it's one of the only companies in the world where you can 24/7, 365, you could go see like how collateralized the company is based on assets and debt, which is incredibly transparent. And on a pro forma basis, so showing this on a pro forma is helpful because they've got about $3 billion of convertible debt that's currently trading in the money as equity. And that convertible debt that's in the money trading as equity is likely already hedged out, meaning that the buyer of the convertible debt has already shorted and bought back their position completely, such that they have short interest held on the stock, but it's held 1-to-1 with equity. So when those convertible bonds are closed out, there will be a canceling out of the short interest and the canceling out of the equity, basically a neutral impact on the stock. And that would cancel the technical debt held on balance sheet. So bringing the net capital held on balance sheet up to 54.5 billion, dropping their liability asset or their leverage ratio down to 13%. And that gives a debt coverage multiple of 7.6 times. Basically, they have 7.6 times the amount of assets than they do debt on the balance sheet. So the final two rows down here, I think, are important and valuable to look at. So everybody says margin call, right? Like all the bears say margin call. MSTR is over leveraged. They're going to have a margin call. Well, first of all, none of the debt is secured. So the Bitcoin, they don't have to sell the Bitcoin at any point. They have no covenants within the debt that requires MSTR to sell the Bitcoin. So that's the first point. Second point is, in order for there to even be any problems to begin with, the price of Bitcoin would need to fall below $14,000 and stay there for an extended period of time while the convertible debt comes due. That means the assets held on balance sheet would be worth less than the debt. So that would be how there would start to be issues, if there would start to be issues. But I guarantee you, everybody listening to this call would be selling their teeth and their t-shirts and their Pelotons and their weights and everything to go buy as much Bitcoin as humanly possible. And that would be an 87% drawdown from here. And just based on how de-risked Bitcoin has become in the last 12 months with government adoption, legislation, SEC, new administration, all of that jazz, I think that's a very incredibly low probability. Now, the last thing I want to point out here, and maybe I'll zoom in to make this a little bit more clear, is I wanted to point out the net capital held by MSTR. So this is the net capital. That means this is just the general assets less the debt held on balance sheet, right? So as of today, 62.8 billion of assets, and you've got, what is that? 11.4 billion of debt. So that's $51 billion of net capital. Now just go look at the companies that have $51 billion market caps, right? 51 to $54 billion market caps. Basically, the net capital that Strategy is holding on its balance sheet right now is bigger than the entire market cap of FedEx and Aflac and MetLife, like large, systemically important insurance companies, right? And distribution companies, public storage, and energy companies, et cetera. So it's incredibly powerful. That's the reason they're trading so high right now. In my opinion, I think they're undervalued and underpriced because the amount of capital that they hold is just incredibly strong. Like, this is the strongest financial company in the entire market, in my opinion, especially if you're denominating your world on a Bitcoin standard. So I will pause there. You guys have anything to add?
Yeah, I've been thinking about, I know the ATM on the common stock is a dirty word, and we've been so excited that we don't even have to use it anymore because we got all the preferreds. But using it is what got us into this strong deleveraged position in the first place. And, Saylor likes to talk about these closed systems, and it just seems like we can heat up the system with the preferreds and we can add leverage, but it's the ATM on the common stock that lets us kind of vent that pressure if they were to ever get deleveraged, or over leveraged. So it's going to be funny to me at some point if people start clamoring for the common ATM, like, oh, we're getting to the top of our leverage, and like people start whining and complaining that they want more ATM on the common stock. I just think there's a future where that could possibly happen.
Absolutely. Totally agree. And one other thing to point out here, right? Strategy has told us that their target leverage ratio is between 20 and 30%. So if you look at that pro forma column, that column AT, you're at 13.1% leverage ratio. And now Bitcoin price could fall and that leverage ratio could rise. However, there's still room and capacity to potentially grow that pretty significantly. They could take a significant increase in the amount of debt and leverage held on balance sheet and still be within the target leverage ratios. The reason they target that 20 to 30% is because that gives a huge buffer. If the price does fall, 65% in a short period of time, they're still not going to be over levered. And I think it's a protection mechanism. Yeah. So,
I mean, there's potential. We can talk a bit about Stride too here.
I think talking about Stride, jump into Stride. Yeah. Go ahead.
I think that the design of Stride, the non-cumulative dividend clause, was designed such that they could increase the leverage ratio in times of distress, right? And that's something I think about a lot too. Is let's say Bitcoin takes that 60% drawdown, 70% drawdown, that leverage ratio will, by design, increase substantially during that fall, right? If their assets are worth 50% of the current value, their leverage ratio should, in theory, be twice as high. Now, if they have to go back and buy their shares by selling preferred, or if they want to just continue increasing BTC yield, then Stride has to be able to exceed that 30% threshold and still be a valid over collateralized instrument. And since it's non-cumulative, they can exceed that 30% threshold specifically with Stride.
Right. And the reason they would issue Stride in that circumstance is because it is technically the lowest on the capital stack, right? It is the junk grade, the junk grade fixed income product that MSTR is providing, right? You don't want to sell your investment grade product in a time of distress. Maybe they will, right? They can have all of these instruments moving at the same time, right? This is the fascinating part with this whole thing. You have an ATM on every single one of these instruments, and depending on whatever's happening in the market, wherever energy is coming from, they're able to capitalize on it, and they're able to have, I'm sure they've got algorithms in place such that, it's probably a VWAP type algorithm where if there's a lot of energy coming in the door and a ton of volume coming in on the stock or the preferred instruments, you're able to tap it and tap into that increased volume and sell and issue more shares of all those pieces. So, yeah, it helps with the timing.
Totally. But think about the optics. I just think about the optics in a bear market. Like, let's say they had to sell a preferred equity to continue BTC yield, right? They're trying to have consistent BTC yield. If they were already had a 40% leverage ratio just by happenstance of Bitcoin falling, and they were going to go out and issue Strife, the Bitcoin rating on Strife would be decreasing with every $1 billion of Strife they issue. And so that's something they've been able to manage with Stride. Now issuing Stride, they're increasing the BTC rating of Strife and Strike while issuing this junk preferred. So, yeah,
absolutely.
Yeah, STRD was like the last thing that I was, semi worried about. If I wanted to steel man a bear argument and actually like make a decent one, defending that 1x mNAV was the kind of like the only last remaining puzzle piece that I had, and STRD just solves that problem. And really, the only thing that the next thing that I would be worried about would be like when Bitcoin's market cap exceeds the bond market, and we're a long ways off from that. So I'm not really worried about the stock for quite a while.
Yeah, and there's a good question here from Chris. And Dan, maybe you want to take this on playbook and sentiment if they miss a payment on Stride, because you looked into this, right? I mean, these kind of junk, I'm going to say junk because they're, for lack of a better word, these junk instruments, they pay the dividend 100% of the time. They don't miss dividends. That's not the intended goal. Missing the dividend is like the last resort sort of situation. It's like if you're in trouble for an extended period of time and you just need time, that's what these are designed for. And in that circumstance, the price of those would fall drastically, and the relative yield of those would rise pretty significantly, and the market would respond. I mean, these are liquid instruments, so you would see those change over time. But go ahead, Dan.
Yeah, you're totally right. In my research, I found that most preferred non-cumulative preferred equities had made every single payment throughout the history of those equities. And then furthermore, even financial institutions that were about to go under during the financial crisis were still paying these preferred non-cumulative dividends unless the company had actually gone bankrupt. So likely the only scenario in which Strategy wouldn't pay the cumulative preferreds is if for some reason they had to sell Bitcoin to pay the preferred dividend. They had no other access to capital. I would imagine they wouldn't sell the Bitcoin to cover the preferred dividend or the non-cumulative dividend for Stride, although they would sell Bitcoin to cover a Strife or Strike dividend.
Good point. And I'll come back to both of those, and I'll hit the question real quick. So when they use the ATM on any of these instruments, when they issue new shares of Stride or Strife or Strike, it is at the market value, not at par, which is super important, which is like
really important.
Part of why this whole thing works, right? Because as the price of these instruments rise and the technical yield falls, they're able to issue more shares at the new market value price, which is significantly more accretive to MSTR, right? Because you're selling less shares for the same amount of yield. And so you would have technically less dollar cash flow dividend liability on the balance sheet at a future point in time while you're bringing this other capital in the door. So as the price of all of these rise, their efficiency increases drastically. So that's why these instruments have significant torque on the balance sheet, because as the prices rise, as they're more successful, they are more impactful on just overall Bitcoin per share and Bitcoin yield.
And I think there's two ways to look at that. Like, let's say Strife rises to $150 a share and the effective yield's like 6% on Strife. When they issue Strife and buy Bitcoin with it, you can think of it two ways. Either they're arbitraging the Bitcoin CAGR versus the 6% dividend, or they're capturing a $50 gain for each share of Strife they sell, and then they're arbitraging the difference between a 10% CAGR on Strife payments and whatever CAGR Bitcoin is. So you can almost think of it as Strife appreciates as an immediate capture in value for MSTR shareholders because of the difference in liquidation preference and market value, like Jeff's saying.
Right. And then there's another good, Stephen tossed another good question. When will MSTR continue to use the convertibles? Are they basically cooled off from them, or will these three other financial products, ATMs? So the convertible bond market is still open for business. They could go issue those instruments like right now today. I mean, conditions aren't great. IV is low, so you'd sell the convertible bond at a lower potential strike price than you may want to, and the other instruments are far more efficient. So if you think about just how the instruments work, right? Like when you sell a convertible bond, the convertible bond buyer is selling the stock immediately. They're selling effectively 70% of the stock that's issued to them to hedge their position and hedge their downside. And they're doing that on day one. So you get this like massive like jolt of dilution on day one. Now, if you think about these other instruments that they just designed, there isn't dilution on day one. There's dilution one quarter down the road, and then dilution another quarter down the road when they have to pay the dividends. So they, are using these other capital raising instruments to pay the dividends at a future point in time. So the dilution schedule is significantly more accretive for all the other preferred instruments, which is why there's a lot of focus on them and why we're talking about them, right? I would prefer that they use and they build out the market for all of these preferred instruments because it's significantly more accretive than the convertible bonds. Also, there's no time horizon on them, right? So you have no debt covenant of a specific point in time when you have to pay the debt back and refinance or take on additional convertible debt, et cetera, et cetera. So I think there's a lot of focus on that. But go ahead.
Yeah, I was going to say, I think the IV is low just because the leverage ratio is so low. So the good news there is that with the preferreds, they can crank up the leverage, which would increase the an opportunity for a better environment to issue the convertible bonds. So it's almost kind of like they control their own destiny at this point.
And and furthermore, I think Bitcoin's vol is just down too. Like everyone wants to blame MSTR's vol relative to Bitcoin's vol has compressed, but Bitcoin's vol is also at an all-time low. So like that's just something to take into consideration.
Yeah, it's been pretty flat, right? I mean, all things considered, we haven't seen those big 10,000, 5,000 swing days. Hopefully they're on the horizon, but yeah, it's been relatively kind of just up and to the right for the past couple of months. So one other thing I wanted to bring up, and Dan, you kind of hit on this, was basically the leverage, right? Or if you're in a situation where the price of MSTR is distressed, or whatever that may be. Let's say the price of Bitcoin falls 50%, right? If the price of Bitcoin falls 50%, the amount of Bitcoin that Strategy would hold falls 50%. So now you have $30 billion of debt and $11 billion of liabilities. If they need to go raise capital, I would underwrite a loan for them all day. Right, you have $30 billion of assets and $11 billion of debt, and you're holding Bitcoin. I would be all over writing that instrument. Like, that is, there's a lot of capital in the market that would be interested in providing them capital. I mean, the terms may not be great, but they are significantly over collateralized still. Even if the price of Bitcoin falls 50%, 60%, 70%, they're still significantly over collateralized relative to other financial companies that are in the marketplace. So I think that's just a really valuable thing to keep in mind, is like, they can go refinance, right? Like just as anybody can go refinance their house. Like, you can go get different debt. You can negotiate terms on your convertible debt. Like, you're the issuer that provided you the initial debt. You go negotiate those terms and interact with these players in the market.
That's a really good point, Jeff. And Saylor mentions that a lot, and a lot of us retail overlook that. We don't have the perspective you have. And he keeps saying, like, an operating company, not a closed-end trust, can recapitalize and refinance their balance sheet, issue securities, buy back securities. And one point I tend to forget to think about is that refinancing mechanism.
There's so much capital in the market, right? Like, what the market is, $900 trillion, right? There's so much capital in the market that you can go attack if you need it. And your ability to refinance is just the ability to network, right? And so now you've got Saylor and the strategy team, and Fong and Sharish and Andrew. They all have all of the connections in the entire market, right? Like, you got ex Morgan Stanley, like ex bankers, and they're connected to all these different capital instruments via convertible bond, and all these guys. Like, somebody would be willing to give them a loan no matter what, pretty much, unless, like, an asteroid hit. Even if an asteroid hit the Earth, like, somebody would still probably give them a loan. So I think that's just valuable to keep in mind.
Yeah, and it's in actually these, as long as they have assets on the balance sheet that someone counterparty believes are creditworthy to some degree or worth something, they will issue secured, like, someone will always issue a secured loan at high interest rates as long as there's capital on Strategy's balance sheet. So worst case, they could do something like that.
Right. And that's kind of Steelman on the other side of this, right? Like, that's and you don't have, Dan, to your point, you don't have that much perspective of working the capital markets unless you work in the capital markets, right? I've negotiated deals, like, to keep insurance companies alive when they've, half their portfolio burnt down in the Paradise wildfire. Like, you can wheel and deal on anything. Everything's negotiable, right? Everything's a contract on big money, and everything's negotiable. So I know you guys were speculating, at least in our group thread, on some additional or future products that may start with STR. You guys want to toss out some ideas, what you think might be on the horizon?
Yeah, I think Adrian's got that one.
Oh, well, yeah, we came up with, what was it? Smurf, Strip, and Slurp.
Slurp.
So I don't think those are going to be necessarily viable in the market. But with regards to other offerings, I've actually been playing around that idea. At the current time, I don't know if they have a need to. I think they have every kind of offering that they would need for the near-term future. And it makes far more sense for them to grow these markets and grow these offerings and grow the market cap of those before they would further add additional offerings to the market and potentially remove interest from those offerings. Because if you think about Strike, it's giving you that potential upside with a dividend. If you think about Strife, it's acting like the bond, and now you have Stride acting as that quote unquote, the junk bond. What other offering do they really need at this point? They have them all sitting around the primary equity of MSTR, and we have 4 flywheels operating. I call it the 4TM. That's what I started calling it in the on Twitter. they have that run. They have the ability that they're going to start running that because he's going to do it on Stride. It's only a matter of time. So I think they would actually, and I don't want to use the term hurt, but they may hamper the impact long term in the market of these three offerings that they bring in another one anytime soon. I can see them looking into it probably by the next cycle, but I don't know if they have a need for it within the next 2 to 3 years. I just don't see it.
What about
Well,
foreign capital markets, Adrian?
Foreign, yeah,
Other
it's
jurisdictions.
Foreign. Well,
would that be the same product? That's actually a question I have for you guys. Is would they just offer Stride in foreign markets, or would they have to create a different security to offer in these foreign jurisdictions?
so I think they can potentially do Stride in those different jurisdictions, but where it gets complicated is where does the money sit and how does it interact?
Oh, got it.
So like apparently that's some of the issue where it's like, okay, let's say you raise this capital in this other jurisdiction, and you buy Bitcoin with it. Do you buy the Bitcoin and send it to the US? Like they don't want you to do that. Right. So do you buy Bitcoin with it? Does it sit in that jurisdiction? How does it move? Do you have to have an entity in that jurisdiction? When you file for that product on that marketplace, what are the rules and regulations that exist in that marketplace? Is it better to just have a whole separate instrument with a separate like sidecar vehicle that sits in that country and all the capital sits there and there's some kind of interaction between the parent company? So I think it's incredibly complex and a little bit harder, more difficult than we may think it might be. But one thing that's really unique about the three products that they've done right now is that they all hit different market needs. Right? They hit different pools of capital. It's not like they threw out these three products and hitting the same group of capital. I mean, retail has access to them, but right, you've got the investment grade bucket that's fixed income with the least amount of risk. You've got the junk bucket, which is higher yield, like high yield savings account kind of thing with anybody that's looking for junk bond status type instruments, and then you've got the convertible preferred, which is anybody that wants that equity like upside with downside protection. So that it fits three different solutions. And I think there are other pools of capital out there that may have similar type solutions. I mean, what they could potentially offer one that's got a monthly dividend, right? Like that would be appealing, right? All the three instruments that they've got right now have a quarterly dividend, and maybe right.
Yeah, so they can do that, but I would almost see. So this is why I said that at the current juncture, I don't know if they have the need for it. It would make more sense in my mind for these three offerings to scale much larger before they would look into doing something that's monthly. Right now, because that does make sense. So it'll be a different offering, different dividend percentage. They can do it monthly, but like the foreign markets one, I see that being viable when they're much, much larger. When I think when the market cap of the company is approaching like, I don't know, 500 billion, that can make a lot of sense for them to have foreign offerings on top of monthly offerings, on top of quarterly offerings, because at that point you're essentially operating as I don't know, I don't even know what you would classify them at that point if I really had to think about it. But that is the kind of future I can see. Just that near term, I think they're very, very, it's very, very beneficial for them to scale these three as large as they can get near term and ride the market that they create to scale. And besides that, though, I mean, there's all kinds of things that they can do once that threshold's hit.
Yeah, I mean, I kind of disagree, right? The only reason is it just takes time for the market to be built on these. And if you've seen how Sailor moves, that team moves fast, and they get the products out to market. And he's over here pounding the silicon on the AI of like, what's the next product I want to issue to the market? What's the next best capital pool that I could go tackle? And I think they could do another one in a couple of months if they're able to. Like they all have runways, right? Where you have to get it out to the market for the market to digest it and figure out what it is, right? I mean, Dan, how long did it take before it Strike clicked for you? And you pay attention to this stuff every day.
Yeah, it took a long time.
Took like 3 months, right? Mm-hmm. and that was just taking time thinking about, okay, how does this work? How does it work together? Who would want to buy this? Why would they want to buy it? And you're paying attention to the stock every day. Now take a traditional bond manager or like a preferred equity manager and they see this instrument come out and they're like, well, what is this thing? And they've got to start at ground zero of learning this company. So it behooves them to get all these instruments, just like get them out to market, even if they don't, if they're not super attractive right away, just because you have those instruments in those markets, and it's going to take time for the education to grow. So I think our job is going to be harder here in the near future, with more instruments potentially on the horizon. Maybe they take a little bit of a break, but I wouldn't be
I would think
surprised.
market saturation would be a concern in terms of just perception, but I don't know. It's possible that they can spool up another one really, really quickly. I'm trying to take the approach of what is the net benefit, moving fast and consistently moving fast, or letting the market build and scale, and then seeing what you can do after the fact, because they've already gone from having the primary equity to 3 offerings, right, in a matter of 6 months.
Yeah, 5.
5, right? So I'm just thinking to myself, what is the net benefit of saturating the market with more offerings at this point? I know what you're saying, that it takes time for these things to build, but the opposite could also be true. Once they have the scale, it will be easier for them to build it.
But
So
I
don't know.
think the point is, you're not saturating the market, you're just hitting a different market. Like there would be, you know what I mean? It's like you'd be tackling different pools of capital with a different instrument.
All
So-
tied to the same company. I'm
All
just
tied to the
thinking about
same
it in terms
company.
of market perception is what I mean.
Yeah. I mean, people are going to be bewildered, right? Like, who cares, right? If you know how the math works and you know the numbers, who cares? People are going to short the stock. Jim Chanos is going to short the stock. Jim, I hope you're watching this, Jimbo. Thanks for all the conversations recently. It's been great. But yeah, I think there's more on the horizon. I don't know. We'll see.
We could try to reverse engineer it from what we've seen them do already, right? So we know Strife is going to be at the top, so they're not going to rug pull their own crown jewel to create something that has the same interest rate, or the same dividend, and is just as safe, right? So they came out with STRD, and they had to really that clause where they can maybe not pay the dividend.
Mhm.
That's really only there to just, like, you have to rig it in such a way that it is inferior, so it will trade at a discount, so that it's
That's a
a
great
little bit
point.
more a little bit more risk for a little bit more reward. And somebody in the chat was asking why retail would buy it, and it's because it's paying an ungodly interest rate right now, and it should always trade at a discount to Strife. So if you want to take a little bit more risk and get paid more, and buy in for cheaper than you could for STRF, then you'd go for it.
All I'm saying is that there's a definite, since sentiment drives a lot of this, there's a definite consideration for market perception and the market perceiving it as too much saturation with too many offerings too quickly. That's the only thing I'm raising for consideration. Not saying that the market will be right. I'm saying that it could be a consideration.
Yeah.
Yeah, and when that time is right, I was trying to figure out other niches that they could that they could do, and one would be something that is a variable rate. And a year ago, I did not realize I was going to be like internet sleuthing freaking different types of preferred stocks, but they could tie it to the overnight rate, something like that. There's preferreds that are doing that. They could, the other niche that I was thinking that I found that they could potentially do would be a fixed duration. So 5, 10, or 30 years, and it could actually, you just know up front how long you were going to be able to hold this thing before it was going to mature. They can play around with those things with the dividends, and I don't know if they would know exactly where they would fit in the stack, but you'd know once they hit the market, and whatever the market decides they're priced at, you'd end up with one more thing to compare with.
We're going to see so much arb trading between all of these different instruments as well. Like we're going to see people that are, because these are the most liquid preferred instruments in the market that the market has ever seen, there's going to be trading amongst all of them. And I think that's one huge benefit here that is probably overlooked by most people, is that because these are liquid fixed income instruments, the most liquid fixed income instruments, you have a whole host of arbitrage opportunities against other fixed income instruments based on how fast they move relative to interest rates, et cetera, et cetera. And I think the liquidity is also incredibly helpful, right? This isn't like an OTC fixed income bond on, some podunk tiny little company that's just not liquid in the market, right? You're getting yields that are higher than podunk company that is not liquid. Dish, like a Direct TV corporate bond, is not liquid, but this is incredibly liquid and it's paying a higher yield. So the attractiveness of these instruments is really high right now, and I think it's just only a matter of time before the market begins to see how attractive they really are. So I did want to get into this, and I think it's a good timing when we're talking about these things. So what you're seeing on the screen here, this is the yield of these different instruments over time since inception. So down on the bottom here, this is the 10-year U.S. Treasury over time. So you can see it's relatively flat. At the beginning of February is about 4.5%, and as of today is about 4.4%. So relatively flat. The blue line, this is STRK. So this is the lowest yielding product at the moment, but remember, it's got that convertibility option. So it can convert 10 shares of STRK, can convert into 1 share of MSTR at a future point in time. So there is not only are you getting paid 7.4%, which is a big delta between the 10-year U.S. Treasury, you also get a call option on MSTR into perpetuity forever. So it's just a really fabulous product there. And then the black line is STRF. So this is the investment grade product. This is the least risky product. So in the capital stack, it goes convertible bonds, STRF, STRK, STRD. And that one's currently paying around 9.5, 9.6% as of today. But you can see the general trend here. Since it launched, it paid, I'll say around a 12% dividend. It got a little bit worse, and it has been drastically dropping over time. Again, this is incredibly powerful because as the price of these products rise and the relative yield drops, they become more beneficial to the MSTR shareholders, because the capital that you're bringing in the door on each one of these ATMs is directly going to buy Bitcoin, and you're taking on the excess risk that these fixed income holders do not want to take on. So it's just a great product. And then the last one here is STRD. As of today, it's trading at 11.3% yield, so highest on the stack. And we'll follow how these change over time. Now over to the right is credit spreads. So this is mapping the delta between these two instruments, the STRK instrument, the STRF instrument, and the 10-year U.S. Treasury. So this is basically known as like the risk premium, right? So the gap between the risk-free rate, which 10-year U.S. Treasury in this case, is the credit spread. And the gap between, the black line and the red line is the credit spread for STRF. So this is how much additional risk the market is pricing in relative to the risk-free rate. So we'll go over to it here. And so I'll draw your attention. This looks very similar to the last chart. As you could see the credit spread change over time. But basically what this is showing is that the credit quality, the market has said that the credit quality of these instruments is improving. That's effectively what this table is showing. You can see the blue line is kind of went up over the first couple of months as it was trading, but since April, the price of these products has been rising, and the market is starting to understand the value, the relative credit of these instruments relative to the 10-year U.S. Treasury. So you start to think about, like, what are the risks, right? What are the risks for any of these instruments? And we kind of hit them at the beginning. It's you've got digital risk, you've got collateral risk, you've got potential custodian risk, and you have to compare how these risks stack up relative to your effective risk-free rate, your ability to print money. And I think there is going to be a point in time in the future where the STRF product does flip the US 10-year Treasury, and the relative yield of the credit spread between STRF and the 10-year US Treasury will flip negative, aka meaning that the strategy preferred instrument will be less risky than potentially what the U.S. government is offering. I think that's a possible horizon. That's what I'm here for. I'm excited for that potential future. I think we'd be positioned pretty well. And the reason being is that they are managing the collateral incredibly well. The balance sheet is incredibly strong. They've got 10x more Bitcoin than anybody else, and the size and scale is the real moat. The real moat here, like they have a digital capital moat, which is a dollar moat, and I think they're going to be the strongest financial company the world's ever seen. And we can get into some of that data in a bit. So you guys have any questions on this, like the credit spread, how I've got it lined out here?
When I first learned about credit spreads, I thought it was some like wicked complicated metric to calculate, but then I realized it was just a difference, and it made it a lot simpler. So for anyone listening, credit spread is just the difference.
Just a delta. Yeah, just a simple delta.
It's kind of saying credit spread is like the equivalent of Jeff Park saying risk vector.
Yeah. Yeah. So one thing that's also pretty neat here is you can look at when the credit spreads of each of these peaked, the 10-year U.S. Treasury was at its lowest. And so as the 10-year U.S. Treasury has been rising in recent weeks, the relative price of these other instruments is falling and the yield is falling. So you're getting this like compounded effect of the credit spread, right? Your risk-free rate is rising and the relative premium, the risk premium of these other instruments is dropping. So you get this kind of compounded effect on the credit spread. So you see this, the delta is dropping quickly. So you could look at the linear trend. The trend lines are the dotted lines behind each of these. The blue dotted line is the linear trend since inception of STRK. The black one is the linear trend since inception of STRF, and the relativities relative to the 10-year U.S. Treasury, which has been slightly up over the same time horizon. Cool.
Yeah, no, I think this stuff's really, like if you're in this trade and you're looking at strategy, you're looking at MSTR, and then you see all of what's going on here. I mean, I think a lot of this first time repricing of these debt instruments up to their actual, effective or risk credit spread that should be appropriate is a once in a lifetime kind of capital ramp up. And that's why I've been loading up on Strike, is I just believe that this is kind of a once in a lifetime opportunity to realize that appreciation.
Yeah, why don't you walk through that? Because I think a couple you've been posting that you've got these products, which is I think a great idea, and walk through that say that exact same thing and explain why you're holding these.
Yeah, well, because if you look at the capital stack there, 5 to 10 to even more, I haven't checked recently, over collateralized by the Bitcoin holdings, which is something that most fixed income products or even preferred equities aren't by their principal companies. And so what I believe is that these should be trading at maybe 100 basis points or 200 basis points above the risk-free rate of like 4% or so. And so what does that mean? Well, it means the principal has to appreciate such that yield declines relative to its value. But the way I look at Strike, at least, is Strike has that convertible option and then also the cash on cash yield. So I think Strike is just this weird instrument where you're getting like 11 or 12% yield on the cash portion you hold that doesn't represent the convertible option. Whereas then the convertible option itself is actually in a way a superior MSTR product because you get that $100 liquidation preference. So I still think the market's underpricing Strike in a way that is tough to explain without like visualizing it. And finally, what I want to say on that is it's a one-time thing. Once the market believes Bitcoin credit is a thing, it's not going to fluctuate. And I know Penny Ether's in the chat talking about how how the reason this is changing is because of the price of Bitcoin and the over collateralization. I'd argue that market participants aren't going to value this Bitcoin credit differently, whether it's 5x or 6x over collateralized in the capital stack. They're going to have to come to terms with the fact that Bitcoin is in fact collateral. And that's what we're seeing right now in the price appreciation of Strike and Strife. It's the fact that the market's coming to terms with Bitcoin is collateral and the idea that MSTR can cover those dividend payments by selling equity. And it's not dilutive in a sense. So I think it's not necessarily just the amount of over collateralization, but instead the concept itself. Yeah. Which is a one-time deal.
And these are fixed income instruments. You need to compare them to fixed income instruments, not the underlying asset that MSTR holds, right? Like that's That's the product. It needs to be compared relative to the risk-free rate. And that's how the market is going to start looking at these products, is the delta between the risk-free rate and this risk product, right? Like these are risk products that are paying you a yield for taking on that risk. And Dan, I think your point is really important. These are this is kind of like a one-time benefit, where once the market does realize the relative credit rating of these instruments, the collateral of these instruments, understanding what the risks are, if they get rated, they're not going to get like unrated. Like they may get rating downgraded or upgraded at future points in time, but they're not going to get unrated. And once these instruments are rated, you're going to have a whole nother entire, 90% of the fixed income market can potentially buy these things. So that's a huge benefit coming for these instruments at a future point in time. Also, if you get to a situation where interest rates drop, the relative yield of these products looks significantly better than if the interest rates drop, the yield is going to look high relative to the risk-free rate. So that credit spread may stay constant, but the price of these instruments may rise and the yield may fall in line with the credit spread, offering a different additional principal price appreciation. So it's good stuff. Great products.
Yeah, great products, really. And interesting thing I learned today was that Strike and Strife are both marginable securities on Fidelity, whereas STRD is not yet. And I don't know if that's a difference between the cumulative nature of the STRD dividend, the fact that it hasn't been trading for more than a single trading day, X, Y, and Z. But that's an interesting distinction on Fidelity brokerage, as I was trying to buy Stride on margin.
You're like, how can I buy these on margin? Right on.
I'm like, well, I can buy X amount of Stride, or I can buy double that of Strike.
Yeah. How long does it get these take to get these rated? Who knows? It could take a while for these to get rated. There are several rating agencies out in the market, 3 big ones, right? You've got S&P 500, Moody's, and Fitch, and it just takes some time getting in front of them. I'm sure that they're on this marketing campaign and blitz trying to explain what these products are doing, and each one of these credit rating agencies would put their neck out to put a rating on any of these products. It is a risk for them, right? What happened in the 2007, 08, 09 financial crisis is all of these investment grade instruments ended up going bankrupt and they were worthless. And go watch The Big Short. And they now have like rules in place to prevent that from happening again. They're a little bit more strict on what the ratings may be. So now you come in the door with this completely novel instrument backed by Bitcoin, which is unknown by many, and many people don't understand what these things are. And then you have a company that's taking leverage on Bitcoin in different ways and offering these new products that are created by AI that the world has never seen before. And it's just so many things that you have to explain to a group of people that maybe are a little bit archaic and slow in how they look at things. And so it may take a long time. And I suspect that Saylor and the strategy team want to make sure that they get the right rating as well. Like, I don't think they're going to get a rating on these instruments just to get a rating. I'm sure these companies are saying, hey, we'll give you a triple B or, a double B, whatever it may be. But the team might say, well, yeah, Strife should be investment grade because it's 6 times, 7 times over collateralized. And I'm not taking your double B. This is investment grade. And you rated investment grade, or we're just not going to get it rated. And I think that's probably where the conversation's at right now.
And the market can just price it as they see fit as
Right.
well, right? And that's kind of what we're seeing slowly over time. So hopefully the market just prices it.
The market will adjust, but the market will adjust even more when more capital can buy these things. Right? Like it takes
that makes a lot of sense.
It takes more volume, right?
Yeah.
You need significantly more volume for
Right.
There just needs to be a lot more people that want to buy these things, and that will drop the credit spread relative to the risk-free rate. Cool. Shall we shift gears? Dan, there was something that you wanted to go over. We're at 50 minutes here. We're cooking.
Yeah, it actually is exactly what we're talking about now. So let me pull it up here.
Boom. Gotcha.
Do you see it?
Hit it.
Cool. Okay. It looks like a bunch of numbers, but it's pretty straightforward for all of us. So right now, this is the leverage ratio X Stride. So this doesn't include Stride. And the whole idea here is that Stride is like a unique sort of product in that you don't have to fit that 20 to 30% leverage ratio, which I think could be the case. I'm not sure how they're going to use it regardless. So we're at a 16.1% leverage ratio without Stride. Annual interest expense with Stride is $336 million. And that includes convertible debt, all the preferreds. Now, so at these different Bitcoin prices here and at a 582,000 Bitcoin count, this is the effective leverage ratio without Stride. So if Bitcoin were to fall to $60,000 flat, you'd be looking at a 30% leverage ratio with Stride. Now, these three boxes here represent the billions of dollars they could issue in Stride up to these leverage ratios. Because like my whole thing and the thing I've been thinking about a lot is like, okay, you see a 60% drawdown, the multiple compresses, it goes below 1, you have to buy back the shares, whatever, or you have to continue yielding Bitcoin. So you have to be issuing a lot of Stride. So how much can you realistically issue up to certain thresholds? And I think a 50% leverage ratio during a bear market using Stride between the 30% and 50% leverage ratio is completely 100% appropriate. And so you'd see here, if Bitcoin were to fall to 60,000 with the current leverage stack, equity stack, they'd have about 7 billion worth of room to issue Stride up to a 50% threshold. So that's something you can look at and consider.
Oh, wow. Okay, hold on. So walk through that again. So you're looking at the delta. You're looking at the delta between your so everything in column F is a 50% threshold, and you were saying you could go from 29.5 to 50%. You'd raise 6.9 billion via Stride. Holy
exactly.
moly.
Yeah. If you were to lever up that, so in this case, you're at a 30% leverage ratio with your high quality instruments. That 20% delta using Stride represents $7 billion. So that's how much Stride you could ethically issue. They could issue more. They could go up to a 60% leverage ratio with Stride, but
well, it just kind of depends on the performance of that instrument and how much liquidity is there as well, right? You want to manage the interest expense, and if that thing just gets hammered because the price falls and the yield goes up to 20, which I doubt is going to happen, but if it did, Soleil would be all over it. If the yield goes up to 20, he's like, hell yeah. I think we'd all be buying it, right? Like, actually, that's an interesting thought. And Dan, I know we talked about this, right? If you're in a position and you think the market's overheated, the trade may be going from, none of this is financial advice, the trade may be going from leverage to strife for like stability. And if you see that the market does potentially fall, then you would want to jump into Stride because the yield of Stride would probably be rising, which would be much more attractive. You could kind of think of it as like a high yield savings account. And then when you think the tide is turned and Bitcoin is, looking good again, you go back into like leverage, and you just kind of run that cycle over and over again. And you just kind of, it's your own little flywheel. That's an interesting thought.
That's really interesting. I have one more thing I want to mention later on that, but I'll go here in a second. So this is the same deal. It's just with an increased Bitcoin count. I think Strategy will have 650,000 Bitcoin at least by the end of the year. So if you think you're going to see a bear market in 26, how do the numbers change? And with their current debt structure, it just means in a bear market, if we go down to 60,000 in 26, they could issue 8 billion up to that 50% ratio, but bearing all the liquidity and concerns Jeff mentioned earlier, with even more Bitcoin, same deal here.
You could offer even
so
more.
Yeah, exactly. That's the point I'm trying to illustrate.
I see somebody in the comments, if it's at 50%, that means they aren't paying the dividend. That's just completely wrong. They're going to be raising so much capital, even at a 50% leverage ratio. They've got plenty of capital to pay the dividend.
Yeah, considering the dividend payments right now are only 330. So again, that would be 10% of. So here right now the dividend payment is 336 million annually. If we were to fall to that 60,000 price and they were to issue they were to issue here $7 billion worth of debt, they'd be paying roughly 10% on that $7 billion, which is another $700 million. So that's $1 billion a year in debt expense, which I think they could cover, quite frankly.
Yeah, absolutely. I mean,
and that's a dramatic situation. I don't think they'd issue $7 billion worth of Stride in the bottom of a bear market. I don't really see that as being like.
Yeah. Just kind of maybe they would though. I mean, if the market's there. And then you're getting Bitcoin at a discount, right? Like that's if you're just long Bitcoin all the time. If the market, if the volume is there, why wouldn't you?
Yeah,
because
you're totally right.
Because you're going to be scooping up Bitcoin when nobody else is scooping up Bitcoin because you have the instrument that can scoop up the Bitcoin, right? I don't know. That's kind of how I see it. Yeah, I mean, crazy. Holy moly. Okay. I
didn't realize I wasn't bullish enough.
Yeah,
I saw this.
I don't think we're bullish enough. Before we jump into some more data, I mean, Adrian, Soleil, did you have anything you guys want to hit on or topics you want to kind of riff on before we jump into some more data here?
No, I just think that these are these offerings, their impact on the market and their impact on what strategy can do is going to be very, very, very interesting to see it play out over the next 6 to 12 months, and especially into next cycle. Looking at where strategy was in August of 2020, I'm just trying to project forward to what this will be like in by this time in 2027 or 2028. That's the thing I'm having a lot of fun trying to figure out in my head. So yeah, I think these instruments were genius moves, and I think their impact is going to be disproportionate. It's just a matter of in which ways. So yeah.
Yeah, I can't wait to see if the people running the playbook are going to be able to repeat this as well. Because I know Dan was saying that Strike is the price right now is kind of like a one-time deal. But if somebody comes out with their own version of Stripe, Strike, and Stride, will the market already have figured out the strategy versions, or will this all just kind of like play out in a smaller scale with these other companies? It's gonna be fun to watch.
I think
I don't know if any of them can
look at
do it.
They should. They should. All of them should.
They should, but could they? Like, would the interest be there? Like, what if you already have strategy doing this? Would they have the same level of interest?
The interest would be there. The yields would just be higher.
Really?
Yeah, the yields would be higher, right? Like there's more risk associated with.
Depending on the over collateralization.
Yeah, well,
right?
right. It depends on the collateralization, but also like a smaller company is more risky than a larger company. Period.
Totally, and they don't necessarily have the track record.
So like, and that's, I mean, there's going to be arbing in between all those products, right? Imagine 1,000 Bitcoin treasury companies with fucking preferred instruments, and there's just algos that are arbing between like the price of Bitcoin and all of these different instruments and different yields and between the common, and it's just going to be a whole frenzy of algos between all of these different liquid instruments that have never existed before.
Yeah, there's going to be a lot of algos, guys.
There's going to be a lot of algos.
So you're saying there's not going to be a shortage of things for us to cover?
I don't think so.
Yeah, exactly.
I don't think so.
But Stride, like, look at Stride, right? It launched at $85 and it traded up to $89 today. Like, with a cumulative, it took Strike and Stripe traded, didn't they? They traded up very, very slowly at the beginning. And Stride is essentially a worse product in theory, but it's already trading up because people know it's going to close that liquidation gap, I think.
And I mean, what, this last week, the amount of capital that they raised is going up, right? Like we're looking like an exponential trend here every single week when they're issuing these, or the ATM, right? I'm going to pull up the graph.
Yeah, let's look at the graph.
Back to the data. We're going to throw the graph up. Also, penny ether is a total bear. What the heck? Okay, here's the graph. Okay, this looks pretty exponential to me. Shout out CJ that's tracking this. I know a bunch of other people are tracking this, but everything in the orange is STRK, and everything in the green is STRF. And eventually there's going to be a STRD ATM that sits on top of this. So just last week, They issued $112 million of these instruments, and you can see the interest is continuing to rise as the market is figuring out what these potential products are. So, can this continue? I believe it can. What's the limit? I have no idea. We're going to see weeks that these numbers are going to be down because the markets just may not be there. And there's going to be weeks where this is higher, et cetera, et cetera. But I think the general trend, if you zoom out, is going to be they're going to be raising significantly more capital as the market is figuring these products out.
Yeah, I think these products there's going to be massive demand for them. Like, that's something I wrestle with too, is like, I've thought about it a lot. It's like, will there always be a demand for an equity at a premium or a leveraged Bitcoin equity? I mean, I don't know, but will there always be demand for 10% yield? I mean, yeah, like, so long as there's fixed income products in the market, there will be a demand for a high dividend over collateralized equity. And that's just something I keep thinking about.
Yeah. And STRK here is the other interesting, and just thinking about the structure and where they sit in the capital stack, right? STRF, STRK, STRD, as they issue more STRK, that pushes STRD closer to risk too. So there's this dynamicism of like how close each one of these instruments is to risk because of the size and of the issuance of each one of these products. So, and the underlying price of the Bitcoin, which will be, again, something that people are going to be tracking. There's going to be algos that are spinning 24/7, 365, moving around between all these different capital instruments.
Yeah, Bitcoin's going to tick down 1%. They're going to have an exact, fair value price for STRF based on that Bitcoin move, based on everything. It's going to be nuts.
But I think the large general thesis here is that the entire fixed income market is mispriced. Either all of these instruments are mispriced, or the entire fixed income market is mispriced. And I think it's a little bit of combination of both, right? So we're talking like a 600, I'm looking at you, Penny Ether. We're talking a $600 trillion market that's mispriced with physical risk, vacancy risk, things blowing up, tax risk, all of these different things, right? You think about real estate, you've got all those issues. You think about fixed income, you look at comparable fixed income instruments in the market, like the PG&E convertible bond or PG&E preferred equities paying 6.5% interest. They just had a $10 billion loss in 2018 from the wildfires in California, right? Like, that's a completely different risk profile than anything that's digital and 6 times over collateralized, right? Like, the entire fixed income market is mispriced, and that capital is hungry for better products. And here you now have better products in a slightly different vehicle that are powered by Bitcoin. And the demand is going to be off the freaking charts. Like,
yeah, totally. Really well said.
We're in month 5 of these things, right? Like,
and everyone can make money on them. That's a beautiful thing. If you're here and you believe this, if you think everything we're saying is true, you can go out and buy them and make money. It's a beautiful thing.
Yeah, it's great. That's great. Okay, so we shift gears. So we look at some freaking data. I've got a bunch of data and some moon math. We'll go through it. Should be good. It'll be fun. I've got some serious moon math. Sorry about people's screens. We're going to have a lot of white Excel here for quite a while. RIP anybody that's watching this on a big screen. So we're gonna jump right into it. And you guys stop me at any point if you got any questions, and I'm just gonna run through this. So this is the Q2 earnings estimate, before taxes. So take that into consideration. Bitcoin price as of today, $108,500. And so the gain on the Bitcoin held from Q1 is about $13.7 billion. Now, Bitcoin accumulated in Q2, you got 53,000 Bitcoin. And the gain on the Q2 Bitcoin, because the average price of the Bitcoin purchased in Q2 is $95,000, made about 678 million on that Bitcoin held in Q2. So the net gain in Q2 is 14.3 billion. This clears the positive earnings over the last 4 quarters threshold by $9 billion. Let's just do some quick math. If the Bitcoin price fell to $94,000 today, the earnings for the period of $5.9 billion would still clear the last 4 quarters of net income, and it would still be positive, thus qualifying for the S&P 500 by $605 million. So basically, we've got a pretty big buffer left between where the Bitcoin price is today and where it may close at the end of Q2 for Strategy to have positive earnings at Q2, thus qualifying for the S&P 500, which I think is going to be the biggest story of 2025. Like, a lot of attention is focused on the Bitcoin treasury companies at the moment, but I really think that this S&P 500 potential and the bewilderment potential associated with that is the biggest story of the year. I mean, it's a significant amount of capital that may be coming into MicroStrategy, and it could drastically change the capital landscape. So part two here is I wanted to look at the trailing 12 months earnings. So I wanted to get a true PE ratio. So if you go on like Yahoo Finance and go look at PE ratio, it's zero, because technically last quarter they were negative, and FASB fair value accounting was taken into consideration for the last year in 2024. So they actually didn't reflect the $12.7 billion gain that they had in 2024. So all of the websites that track PE ratio are incorrect because they have the wrong earnings number. So I wanted to back into what the earnings number actually should be and what the PE ratio should be. So I wanted to see the trailing 12 months earnings on the Bitcoin that they've purchased in the last 12 months. So in the last 4 quarters, they purchased 367,600 Bitcoin, which is a shitload of Bitcoin. And the gain on that Bitcoin is $6.6 billion. The amount of Bitcoin that they purchased prior to 12 months ago was 214,000. And their average cost basis on that 214,000 is 67,000. So the gain on the Bitcoin that they purchased prior to 12 months ago is 8.8 billion. So a composite net income before taxes, right? So there's this number is skewed of $15.4 billion. So the shares outstanding, 279,525,000, a trailing 12-month earning per share estimate of $55. So the current MSTR price is $387, and that brings a trailing 12-month PE ratio of 7. The S&P 500 average PE ratio is 26. The QQQ average PE ratio is 35. The Mag 7 average PE ratio is 31. So if you were to take any of those PE ratios and apply it to MSTR's trailing 12-month earnings, you'd get a price between $1,400 and $1,700 is kind of fair if you were to take the average PE ratio for the Mag 7 companies. What is the primary difference between all of these other companies or all of these other categories of stocks and their PE ratios? It's primarily inclusion in the S&P 500, right? Like all of the Mag 7 is included in the S&P 500. S&P 500 holds anywhere from 5 to 7% of the Mag 7 stocks. So these are passive flows that are coming in from insurance companies, 401ks, and that are everybody that's buying the S&P 500, which is it's trillions of dollars of capital that's following the S&P 500. So it's a really big deal. Any questions on that so far? No, we're cooking.
Yeah, it all seems good to me.
Okay, so there's one other component here that I think is missing. And so you've got about $3 billion of shares that are currently trading in the money from the convertible debt. And so when you look at the market cap of the company is a reflection of the shares outstanding, not fully diluted shares. And there's roughly 14.7 million shares that are currently trading as equity. They're pegged to the convertible debt. And I think the market cap of MSTR is probably understated by about 5.7 billion. So those 14.7 million shares that are currently trading in the money that are hedged 1-to-1 to shorts at the MSTR price of $387 would be about a $5.7 billion market cap understatement. So just throwing that out there, another piece of data that's really interesting. All right. Now I wanted to shift gears, and this is where we get into the moon math. Maybe I'll make this a little bit bigger so you guys can see it. And this is going to be confusing. So hang with me here. So I wanted to get to a price earnings to growth, a PEG ratio, which is how most of the large Mag 7 stocks are compared against each other. So this is price earnings to growth. Basically, what is the expectation? What is the expectation of the growth in earnings for any one of these large companies? Why is this important? This is important because the Mag 7 stocks basically pay zero dividend, right? Like some of them pays dividends, but it's like 0.71% dividend, right? Nobody's buying Microsoft for the yield, the dividend yield. So what's the point of holding the company, right? What's the point of holding the equity? You want price appreciation and some sort of like growth of that earnings. And the price will reflect the growth of that earnings in a future point in time. So I wanted to compare that concept to how strategies earnings can grow into the future, right? Because we're calculating a PE ratio and the relative earnings. So I looked at the Bitcoin that they hold on the balance sheet today. So that's in this column here, 582,000 Bitcoin. And I wanted to project an estimated Bitcoin yield into the future, such that in 2035 we can see, all right, how much Bitcoin would they hold net of dilution in 2035. So I think it's actually probably helpful to take a pause real quick and talk about what is Bitcoin yield. Bitcoin yield is the percentage change. Wait, hold on. Yeah, BTC gain and Bitcoin yield. BTC yield is the percentage change in BTC per share. And Bitcoin gain is the BTC acquired without share dilution. So in both of these considerations, it's when I'm looking at Bitcoin yield, I want to keep share price constant, and I want to look at the amount of Bitcoin that I project MSTR to hold in the year 2035 while holding share count constant and not taking into consideration dilution. Actually, it is taking into consideration, it's just omitting the dilution and the Bitcoin acquired with dilution. So it's omitting both of those components. So I've got a Bitcoin yield rate up here at the top in each one of these columns. So in 2025, I'm estimating a Bitcoin yield for the rest of the year of 20%. They're at 17% right now through June 11th. So if they doubled what they had today, that'd be another 20%. And projecting at 2026, 10%, 7.5% for the next 4 years, and then 3.5% for the next 4 years into 2035. Dan, you follow? Soleil, you follow?
I like this.
Okay.
Stuff,
Yep.
yeah.
So I'm projecting a Bitcoin yield. Again, I want to think of net of dilution. I want to keep the share count constant. Right. And then I looked at Bitcoin CAGR. So I wanted to play out a compound annual growth rate into the future. And what I used for the compound annual growth rate is I used the assumptions from Strategy's Bitcoin 24 model. And this is from Saylor, Charisse, and CJ over at MSTR. And I've taken their annual rate of return projections from 24 all the way to 2035. And you can see it's going down, right? The trend of the compound annual growth rate is an assumption that it's going down over time as the scale gets larger and it's harder to grow the relative network. Cool.
Yeah, I think that's a really good model. I love that.
It's a great model. It's a good base case. Okay. Yeah. So now based on that, in this scenario here, I've got in 2035, I've got Strategy holding 1.2 million Bitcoin based on these Bitcoin yield assumptions. And the Bitcoin gain, so this column here, or this row, is reflecting the amount of Bitcoin that's gained in each one of the years, right? So in 2026, it's just taking the difference between the Bitcoin in 2026 minus the Bitcoin in 2025. And then the year-over-year Bitcoin gain is the relative, that's the Bitcoin gain times the Bitcoin price. So it's reflective of the multiplication of those two.
Yeah.
And then I follow the Bitcoin price here just based on these CAGR assumptions going into the future. So in 2035, we're looking at holding 1.2 million Bitcoin and a Bitcoin price of $2.9 million. That might be high, that might be low, but I think it's a good potential projection on what we might see at a future point in time. So in 2035, and maybe let's just focus on 2035 and just kind of forget all these other years. But now that you guys get a lay of the land, right? So in 2035, if the Bitcoin price is $2.9 million, that means Strategy would hold $3.6 trillion in assets. $3.6 trillion in assets. The largest company on the planet right now is Microsoft, and it's $3.4 trillion, just to put that into perspective.
And the rest of the capital markets will grow, and those companies will grow.
Because fiat's going to keep getting printed, right? So then I wanted to see, all right, what is the earnings that they made that year based on our BTC yield estimate and the Bitcoin CAGR, right? So I wanted to take the Bitcoin gain. So the earnings and the Bitcoin held is a function of, actually, we got to hide here. The earnings and the Bitcoin held. This is just gross. It's not taking into consideration tax. is the Bitcoin price in 2035 minus the Bitcoin price in 2034. Okay. So it's the delta between the two. So how much did the price of Bitcoin increase from 2034 to 2035? Multiplied by the Bitcoin that's held in the prior year. Does that make sense?
Yep.
So basically, how much did the Bitcoin price increase in that year? And I want to multiply it by the Bitcoin held in the prior year. And that's, those assets that are held in the prior year are going to appreciate to that new price in the future year. So, and I'm not even taking into consideration any gain, any dollar gain, Bitcoin dollar gain on the Bitcoin gain during that time period.
Which I think is fair. I actually think that's
It's just
the best way to do it.
conservative as
Totally
shit,
agree.
right? Just super conservative. And that brings us to
And it's the most synonymous
Right.
to earnings. It's new money in
Right.
the door.
So that in 2035 would lead to a $700 billion earnings in 2035. If all of this maths, right? If we agree with this, right? We think that Strategy's BTC yield will decrease over time, and the Bitcoin CAGR will decrease over time. And, if a 3.5% Bitcoin yield in 2035 is reasonable, I mean, we could probably argue till we're blue in the face about that, but it's an interesting starting point, and that would result in an earnings of $700 billion in 2035. So I just assumed a blended strike, strife, and stride yield on that 700 bill, the amount of preferred instruments that they would have to pay. That would result in about a $30 billion dividend payment that the strategy would have to pay out. However, they have $3.6 trillion of assets, and that would only be, less than 1% of the total assets held that they would have to pay out annually. So they're still incredibly strong financially. And then I wanted to back into, okay, what would a price be, right? If we still compare the rest of the market on some sort of reasonable metric, the current shares outstanding is 279 million. You've got earnings per share of roughly $2,506 per share. Let's just say you've got an EPS multiple of 15, which is well below what all the other market is trading at. That would bring MSTR to a price of $37,604 in 2035 and a market cap of 10.5 trillion. Which might be the largest company on the planet at that time, but right, if Microsoft compounds at 6.5% annually, they still might be playing around near the top 5, top 10 publicly traded companies. So, and I wanted to take a step back, right? And how does this compare to Mag 7? How does this what is the compound annual growth rate of the earnings, and how does this all look relative to another? So the compound annual growth rate of the earnings is 49.3%, so about 50%. The compound annual growth rate of Bitcoin in this horizon, on the next 10-year horizon, is 39%. Again, we can argue till we're blue in the face about that. Maybe it's 20, maybe it's 40, maybe it's 50. And the CAGR of the BTC yield I have at 7.7%, which I think is a reasonable conservative estimate on how the compound annual growth rate of the Bitcoin yield moves into the future.
I think you're right. I did a similar model like this, Jeff, and it wasn't laid out this well, but I think I actually had and I'm typically pretty bearish, but I had a much more aggressive CAGR of Bitcoin yield. And I think there's a real scenario in which the Bitcoin yield is higher than this because of the preferred, specifically because of the preferred.
And I walked through that, and we'll hit that next. So the current trailing 12-month PE ratio is 8. Let's just say 7. So that would bring the price earnings to growth ratio down to 0.13. Josh thought I was insane for saying this, but I think this is actually a conservative estimate. If you're taking a 10-year horizon on the growth rate of the potential earnings, you got to go look at what does the earnings look like in year 10, right? What does the company look like 10 years from now? And I got to peel it back to today. And and in order to normalize this relative to the Mag 7, the earnings, the PEG ratios of Apple is 2. The PEG ratio of Microsoft is 1.5, which means they're relatively overvalued relative to Strategy and how it fits in the market.
And it's a matter of whether you think they'll be repriced down or whether strategy will be repriced up to their multiple, to their earnings multiple. And I think the Bitcoin yield is going to be much higher than this, and we'll go through that. I personally don't believe they're going to be priced up to the current earnings multiple of Mag 7. I think they'll be repriced down to strategy's earning multiple. But my price per share in year 2035 is actually higher than yours, Jeff. So even for the people out there that don't think they'll be repriced higher on an earnings per share basis, there's still a lot of hope.
Yeah, and that's you can. There's so many variables here, right? Like this is a really complicated model, and there's a ton of variables that you can play with. The one thing I wanted to put into perspective is the BTC gain. So I took the cumulative sum of the BTC gain across the entire horizon from 25 to 23, and that's $550 billion. So that's effectively, just to put it in perspective, that's like raising $550 billion in the preferred income or on the prefs over the next 10 years. Do I think that's reasonable? Well, what does the fixed income market look like in 2035 based on a 6.5% compound annual growth rate? Right. And so I did that math and I looked at the fixed income market starting today is 318 trillion. The real estate market starting today is 367 trillion. And if you compound that at 6.25% interest rate into 2035, the monetary supply increase, you're looking at the fixed income market being 583 trillion and the real estate market being 672 trillion. So 1.2 quadrillion between those two markets. And in that circumstance, the Bitcoin raised, the BTC gain, effectively how much capital did you raise from the prefs of 550 billion would only be 0.09% of the fixed income market. So I think this is bearish. I think this is like a conservative estimate of what the BTC gain could be in the future, especially if the market starts to reprice all of these different instruments.
Yeah, and it's all because of the preferred equity. Because when you think about it, as those assets are compounded, like Bitcoin will hit a point at which there's a terminal CAGR, right? Much like the S&P or anything like that, where the CAGR stops decreasing, in my opinion, whether that's 10%, 5%, or 20%. As it's compounding continuously, the actual assets on Strategy's balance sheet, they're yielding Bitcoin via these preferred equity offerings into the market backed by their Bitcoin stack. So they're having essentially, they have compound yield, exponential yield on an exponential asset at some point. So that's the real unlock here, is the yield from their Bitcoin stack via preferred offerings. And I think people aren't thinking about that. They're just thinking, oh, well, size of the company. If you use ATM to acquire Bitcoin as the company reaches terminal velocity, that's going to effectively slow down. The thing is the preferred equity offerings play the other side of that, where these actually are an exponential growth on the assets on the balance sheet.
Yeah, I follow. One other thing I'm thinking about here is, right, the world has never seen an asset like Bitcoin before, where you can efficiently store your energy without decay. So if you think about what that means and the implications of that, that means that you're going to see more abundance. So back to your comment on, Mag 7 getting repriced down, maybe it gets repriced down a little bit, but it doesn't have to, right? Because MSTR and Bitcoin is capturing value without decay. And so there can be more value in the market, theoretically, right? I don't know. That's a brain breaker. That's a Jeff Booth comment. We need Mason and Jeff Booth on the scene. What do you think, Soleil? What do you think of this model? Do you want to play with this at all? Like what?
Yeah, I think it's pretty conservative Bitcoin CAGR projection, especially because like inflation is just going to keep going up exponentially too. So I don't see how Bitcoin's CAGR can drop too far too fast. So the numbers are just going to be insane.
Right. It's tricky. This is a tricky analysis to do because it's also all dependent on Bitcoin yield in the early years. Right? Like if you crank up these numbers, like let's just say there is some frenzy and the Bitcoin yield in 2025 is like 50. The remaining Bitcoin yield in 2025 is like 50%. I mean, that totally changes. You go from $700 billion of earnings to $1 trillion of earnings in year 2035, right? Which is just insane. So the early years, because all of this compounds, which is where the torque comes into play, right? And they tried to show this in their earnings reports, where like this thing goes exponential because the existing Bitcoin that you have is earning value, is earning more value over time. It's earning more value over time. You get this Bitcoin income, BTC income, from all of the Bitcoin that you've acquired in the early years, which is just shows again the compound value of the ATM and utilizing the balance sheet early to accumulate as much Bitcoin as humanly possible. So anyway, that's my moon math for the day.
Yeah, I love it, Jeff. Absolutely love it.
And I mean, shoot, in this scenario, right? Look, the only thing I changed was the Bitcoin yield in year one. I took it from 20 to 50. That changed the earnings from 700 billion to $1 trillion. That brings the price estimate to 59,000 in year 2035. The market cap to 16.4 trillion. Maybe I think that could be realistic, right? I think that it sounds crazy to say. But I think that could be realistic.
By 2035? That's not that crazy.
Yeah, I mean, it just, those numbers sound like weird to say, right? Like 16 trillion, nothing 16 trillion. Right?
Yeah.
There isn't a company that's 16 trillion yet. Yeah, right. And now you've got Chris, here we go. This is perfect.
Well, here's the thing. If we roll this back in the past, if anyone had said that Amazon or Microsoft or Apple or Meta or Tesla or any of these companies would be in something called the Mag 7, where they're all valued at either close to or over $1 trillion, that would have seemed crazy too, right? In like 1995.
Right.
But, when things change.
Well, let's compare this too. I've got this data, which I think is super valuable as well. And this is the Mag 7. And basically Microsoft right now is valued at $3.5 trillion. They hold 0 Bitcoin. And the value of Microsoft is 32 million Bitcoin, which is also just crazy to say. Now I looked at the top 10 companies and I took the cumulative market cap. So the top 10 companies are valued at 20.2 trillion, which is 187 million Bitcoin. So that's 8.9 times, about 9 times the amount of Bitcoin that will ever be mined ever. And if we think about any of these companies starting to store their value in Bitcoin instead of dollars, this equation gets really crazy really fast, right? Like the CAGR may rocket in the early years and then start to decay over time. And as you have this exponential growth of humanity, like with AI, and you've got a store of value that doesn't have decay, well, we could see a world of abundance in 10 to 15, 20 years from now, which is like super hopeful. Super hopeful. Unique place to be.
Yeah, completely.
It's crazy to me that people are bored with strategy right now.
I'm over here like, oh my God, like just trying to, well, I think they're bored because they can't conceptualize the scale, right? Like I just said, it's weird to say it's $16 trillion company. Nobody knows what that means, right? Like it's another comma, but no, it's like, it's literally orders of magnitude greater, orders of magnitude. And, people can't conceptualize that, right? Because they're you chase shiny things because it's maybe a faster horse for a shorter time period, right? Like I think there are ample opportunities out there to make a ton of money in the Bitcoin treasury space right now. But the best risk-adjusted return, in my opinion, is strategy, because of their size, their scale, and their ability to tackle these markets greater than anybody else. Nobody else has the size and scale to go issue, $100 billion of preferreds, $500 billion of preferreds in the next 10 years. You need massive scale, and that scale is going to just get even exponentially larger, right? As they continue to issue these preferreds, they just get more of a lead, and they're able to issue more and more because their relative risk is significantly better.
And I mean, it's going to be hard. There's going to be a lot of fallen soldiers along the way. Like people are going to get shaken out. And I mean, we've all felt it. Like, why isn't the price going up? Why isn't the price going up? But if these models teach you anything, it's the numbers are small at the beginning, but it's growing exponentially.
It's the classic scenario of, everybody's got that uncle that bought Apple or could have bought Apple in 1989 for $1.50 or, 50 cents or 25 cents or whatever. And he's like, well, I didn't. And you're like, well, they tell the story over Thanksgiving holiday. And you're like, well, cool story, man. Like, you wouldn't have held it anyway. This is one of those scenarios. You've got this opportunity to hold this, like probably the best performing instrument on the planet for the next 20 years. And people are over here like picking up pennies in front of a steamroller. So it's just it's just a really unique place to be. For me personally, I just don't want to mess up.
Jeff, I'm short calls.
You short calls?
I'm short call. Yeah. They're very far out of the
You
money.
you do weeklies. You do weeklies, right? That's fair, right? You do weeklies like $200 out of the money. That's fine. Yeah, that's good.
Boss.
Look, even the only people that I've, Twitter, there's a bunch of people just getting bored with strategy, but I was tracking the MSTY and the IMST positions the last few days, and they're actually taking long positions.
Both of them?
Both of the funds have uncovered long positions. And I was like, okay.
Uncovered long positions. Like, are they options or are they just like buying the shares?
IMST was like synthetics. So it's basically like holding shares. And then MSTY, they actually had like some debit spreads. And there was some like YOLO next week type shit. And I was like, okay.
Yeah,
isn't there a big options expiration on next Friday?
Oh man, I haven't checked that in a while.
There's a pretty big options
for
expiration, June 20th, I think. This Friday is not small, and then the following Friday is pretty big.
Okay.
Yeah.
Maybe that's what it's about. But I was kind of floored.
Yeah,
like their whole thing is short volatility, and they're like, nah, we're just gonna go long instead.
We're long here.
Sometimes you gotta be long.
They're still. Yeah.
What are you gonna say?
Looking at the options chain.
Oh no, I was just they're still slamming their their shorts, but they're using that money to buy some long positions too, and they're just keeping some upside out there, just in case it rips. So hopefully they see some code in the matrix or something. They know something's gonna happen.
Yeah, we should probably do an update on the options chain at some point in the near future. I mean, Danny, if you're following this, I pulled up June. I don't have a sense on scale. If there's a website that pulls this together, but yeah, we might want to look at that.
Options chart. It's called like optionscharts.io. They'll give you all the open interest by strike on MSTR, and we can pull it up.
There we go. Search ticker. MSTR.
The thing with people getting bored with strategy that's kind of odd is that Saylor's been saying for quite some time now that the plan is to hold for years, whether it's Bitcoin, whether it's strategy. So I don't know how. Well, let me rephrase that. I do know how. People saw the number go up a lot in the last 4 or 5 years, and now they're like, well, do something. Why aren't you 3xing yet, right? But his whole model has been you buy, you hold. That's how you accumulate wealth. I mean, what did he say in the Jordan Peterson interview, right? He bought stuff when it was low. He held it for years, decades, and that's how he got rich. He didn't get rich trading in and out of positions. So I'm kind of perplexed by the more information that comes out about him and the more information that shows that he is a buy, hold, innovate kind of guy. Why are people expecting him to create a stock or have a dynamic where everything is supposed to be ripping up 3x and crashing, then ripping, then crashing, then ripping, then crashing? Obviously, this is a longer term play, and that's what he's building out. So I think a lot of people need to probably reassess what it is they think about strategy, perhaps, or maybe I'm just being too harsh. I don't know.
Yeah, I mean, it's built on an equity that no one has ever lost money on if they held it for 4 or 5 years.
Mhm.
So if you haven't held it for 4 or 5 years, you really have no complaints, I don't think.
Yeah, and Adrian, to your point, like on that interview was great, right? You saw the iPhone and you realized, oh my God, everyone's going to have one of these in their pocket,
Mhm.
right? And I think what you've got now with MSTR is you see these preferred instruments and you go, oh my God, everyone's going to have one of these in their portfolio. Everyone. That's at least how I see it, right? Like I look at the landscape of the fixed income market and I look at this. This looks like the most attractive thing on the planet in a wrapper that they can consume. It fits within their mandates. And so that's kind of how I see it, right? Is
Well, yeah, if you look, because Saylor wrote the Mobile Wave. I think you've read it. I've read it. I'm not sure if everyone in True North has read it fully yet, but he's identified trends. He's got in on those trends, and that's how he's made his money. Right now, what he's doing with Bitcoin, he's identifying a financial trend, right? So he's building all of these offerings on top of it. He's built his company around it. It's either you're going to be along for the ride or you're going to get off the train. Is what I think I'm trying to get at. If you're not a person that can handle the fact that this is a long-term hold and see all the moon math you just did, how the years went on, 20, 26, 27, 28, right? If you can't stick with it throughout that time and realize that appreciation, I think you're just going to end up getting frustrated. But on the flip side, I don't understand how people can get frustrated. They really sit down and understand what's going on. So that's something I've been wrestling with myself, with the chatter that we see and people getting bored and whatnot. Like how else do we put this message across to make them understand that this is what's being done? I don't know if there's anything else we can do besides managing the portfolios for them, but we're not going to do that. So
yeah.
It's just an interesting thing to see play out in real time.
Yeah, you just gotta give perspective, right? Like the people didn't see the iPhone, right? Maybe they saw the iPod and they're like, yeah, okay, whatever. Maybe saw the iPhone and they're like, yeah, okay, whatever. But they didn't understand that like 8 billion people on the planet are going to have these or want to have one of these, and the price of it's going to come down. It's going to get cheaper. Like they came out and they were like, what? I don't know, $800 in like 2008. And it was just like, who's gonna have one of these? It's kind of clunky, it moves kind of slow.
More than that, actually. It was more than that, yeah.
It's got a glass screen, everybody's dropping them and they're shattering, and you're like, oh, this thing was totally dead. And you're like,
you couldn't send pictures, you could only send text, you couldn't send
yeah.
multimedia messages. I remember that. Yep.
Meanwhile, the Razor looked super sick. It was like super durable. You could get thrown in the pool with it and it still works when you come out. You could send all your text messages. The BlackBerry's sending emails and it's got a full keypad. And you're like, okay, you can see all these execs using BlackBerries. And it was, I mean, you could have seen it, right? If you were a bit of a visionary, right? Like this is a significantly better product and it will be more desirable because it's going to get better. It's going to get cheaper. Internet's going to get faster. You're going to have AI platforms on these things. You're going to be able to learn incredibly quickly, communicate fast, and communicate with memes and images and all these different things. And it took thinking ahead. And you didn't have information very quickly back then too. So like, you'd have to go get your news and information from newspapers or magazines, or you go on the internet and everybody's got, dial up internet and reading forums back in the day. Just access to information wasn't very good. And now we have access to information that's significantly better. We've got groups of people that are meeting on the internet. Like all of us literally met on the internet talking about a stock that we like because we think it's the best stock on the planet because of the internet money, right? Like what kind of timeline is this? This is crazy. And now we can do that visionary process together and we can share it with 8,000 people, right? That are watching us right now. And that's just a completely different landscape than where we were in like 2007. Just the access to information was just completely different. So anybody betting against this right now is like, it's just crazy to me on people that are betting against this, because like Bitcoin holders are the strongest, like hardened people on the planet. And they're just going to hold this stuff forever and like work really hard to build the future of the Bitcoin network too.
Well, to anyone doubting the moon math, also coming to your point about pushing it forward and being a visionary and trying to be able to see forward. And I know people say this and it seems cheesy, but when it comes to Bitcoin adoption, we are still very early. There's millions of people that have adopted Bitcoin, right? Not billions yet. So billions is a 1,000-fold increase from here. Just imagine what that means in terms of strategy. Just imagine what that means in terms of market cap. Just imagine what that means in terms of Bitcoin's price. And then I think Jeff's numbers look kind of conservative by comparison, right? And when it hits the point where we actually have billions of people onto Bitcoin, and you have the price appreciation, you have what strategy is, I think it's going to make things like Berkshire Hathaway look quaint in comparison when we look back on it, and the Mag 7 and so on and so forth. It's going to be an entirely different dynamic and a different paradigm. Yeah, it's going to be an entirely different paradigm that just doesn't exist yet. And to you, Soleil, when you said, well, inflation is going to be out of control, right? They're going to be printing like crazy. They have to. Exactly. So throw a few inflationary cycles into that, throw a few printing cycles into that, then they're going to have to lower interest rates again, because that's just what's going to have to happen. Then inflation is going to go up even more, and the price is going to appreciate even more. You see what I'm saying? So looking back on it, we're probably going to say to ourselves, we were kind of undershooting it, because to what Saylor says, it's either going to zero or it's going to like tens of millions. I think that binary is very, very, very much the case. So as long as they continue to manage this thing the way they are, very, very effectively, very, very strategically, and they're doing financial engineering, and they're doing, they're not over leveraging themselves, I have a hard time seeing how they fail.
Yeah. Yeah. The other thing that's being rethought right now, and it's probably very similar to everybody rethinking how they used communication modes with the creation of the iPhone, is like, what's the point of holding an equity? Like, why do you hold equity? Why do you hold an equity? Why do you hold an equity that doesn't pay a dividend?
Well, essentially you're hoping for price appreciation. That's pretty much it.
Yeah. So like price appreciation as a function of what?
Well, right. Yeah.
Like, and that's kind of part of my general thesis. Like, what's the point of holding the Mag 7 if they don't pay you a dividend? It's like, okay, some expectation at a future point in time of some earnings number based on my perception of how big that market is and how much of that market that they're going to have.
I think of it this way: an equity is hope. People are hoping that they have the right read on it, and that equity is going to give them. They're paying now for what value they think they can accrete from it in the future. But to your point, that is all. I don't want to say it's smoke and mirrors, but in a lot of ways, it is based upon future expectations that you hope that will come to pass. While strategy, Bitcoin, represents a far more concrete example, because as it stands right now, even without global adoption, we still have a very concrete use case of 15 plus years or going on 15 plus years, where we've seen adoption growth, we've seen utility growth, we've seen an entire new class of equities built on top of it. The Mag 7 doesn't quite have that. Well, let me qualify that statement. AI is its own thing. So any company that is focused on AI, that is building out that in the future, I think that's a different thesis. But all of the Mag 7 companies can't fully go into that. Some of them are going to sort of taper off. So then you're left with what? You're left with Bitcoin, strategy, maybe a few of the Mag 7 companies, then Ether is what you're left with, essentially. And you have to hope that your equity investments, your bonds, whatever, beat inflation, outperform, the list goes on and on and on. So yeah.
What's the market look like when every company has Bitcoin and you don't have to just search for the company that's going to give you the biggest returns, because they're all expected to at least give you a Bitcoin return plus some kind of venture return on top of it, and you can just buy the company that you agree with their mission. You can just get rid of all of the bullshit research and just be like, this company is trying to cure cancer, I want to invest in it. This company's doing this, I just want to invest in it. It's going to be a completely different mindset.
So I think there's two things that are going to happen. I do think that they're going to be companies that just don't adopt it, and they're going to die off. And I think
Yeah.
there's going to be companies that get eaten by AI, and then you're going to have whatever's left over that's going to have to adopt to this new paradigm of having this hard asset on their balance sheet. Now, whether all of them do it by holding Bitcoin directly or in custody, or maybe they do it by some derivative means, I don't know. But I do think that the future, I'm not certain that's going to be every single company holding Bitcoin in like cold storage through custody, right? I think that
Yeah.
you'll have some using IBIT, you'll have some using derivatives and a blended model.
Oh, sure. Yeah.
But one way or another, I do think that if we fast forward, several decades, at some point, every company, either passively, directed or directly, will have exposure to Bitcoin. I think that's a likely future. Everyone having an store, I don't know if everyone's going to hold it themselves, but exposure to it, I
Sure.
think that's going to be part for the course.
And Bitcoin yield, right? Bitcoin yield is going to be, I think, what people would be chasing, right? Which would be a function of the products that you're offering to them to the market, right? How much Bitcoin yield can you generate compared to everybody else?
And also, Bitcoin could become a weird differentiator. If you are a company that holds, and this sounds like a stupid example, but bear with me. If you're a company that holds Bitcoin directly in cold storage or Bitcoin through a custodian, versus in this future model, a company that has Bitcoin and Bitcoin derivatives, does that now become a different differentiator in the market? If you are a company that has, great devices, great products and whatnot, and everything somewhat becomes streamlined because of AI, because of Bitcoin, because of all these different, I like to call them excluding factors that are going to bleed out the market that we're going to see over the next several decades. Does how you manage your Bitcoin treasury become a differentiating factor? Like you have the pure play of strategy, right? Because they're just doing Bitcoin. Does the market
Securitized instruments, yeah.
Yeah. Well, essentially, but what I mean by a pure play is that they are a company that either will eventually hold all their Bitcoin in some form of self-custody or all their Bitcoin through self-custody and custodians, right? So they're not having any derivatives. They're creating the derivatives, but they're not holding any derivatives.
Yeah.
But in this future, if you have companies that are holding the Bitcoin derivatives and they have a blended model, does that become a differentiating factor? Like how many layers of scaling are we going to see, and layers of differentiation are we going to see when everyone has Bitcoin? Because I don't think it's going to be possible for all companies to be able to have actual physical Bitcoin. I think things are going to get so tight that they're going to have to go to derivatives. And if they go to derivatives, are those companies perceived differently? Is what I'm getting at.
Yeah, that's an interesting point. I agree.
Well, they're taking more leverage or stability or different products. It's a fascinating concept. I mean, this whole just thinking about Bitcoin yield in the year 2050, right? It's like, okay, the Bitcoin yield might be, we probably need to rethink it. It needs to be like SAT yield.
At that point, yeah,
It's going to be
Yeah.
SAT. It's going to be SAT yield, and it's like, okay, our SAT yield is, I don't know, 1,000 or 500. Like the numbers might be higher because you're doing it in like SATs, not in Bitcoin. It's like the fact that it's Bitcoin yield right now is crazy because every Bitcoin is 100 million SATs. So it's really, there should be a lot more. Man, we should calculate the SAT yield and publish that.
Well, if it gets
The
to a
SAT
point where we have
yield, you're like,
SAT
oh
dollar
my
parity,
God.
yeah, like imagine if we get to a point where it's SAT dollar parity, right? So whatever the dollar's
10 million
worth,
bucks. 10 million bucks.
yeah, $100 million, right? Then we get what if it gets to a point where it's like one SAT is $10? Do you see what I'm saying? Like
We're gonna need some more decimals.
well, it gets goofy when you really start to think about that, right? It really does get goofy. So
And that's where the the fact that this asset has never existed before, an asset where you can store your energy without decay, is incredibly important. That's why it's so goofy. It's so hard to conceptualize. Like you're actually, like, everybody should be fabulously wealthy on the planet because the world is deflating, but you've got a monetary system that's inflating, net of deflation, right? Like all of the increase in technology for humanity should go to society.
In theory, it should.
It should go to society, right? So like for the entire technological revolution in the entire 2000s and from where we are at today should have been like deflationary for humanity, but we had a fiat system. I mean, granted, you're going to have things that are, destroy value, like catastrophes, like hurricanes and, wars and stuff. But eventually those things become unprofitable ventures because they don't make sense to do anymore. Yeah, this whole thing, Bitcoin is just so crazy to conceptualize, especially on a long-term time horizon. It's hard to wrap your head around. But I think I think UBI is probably going to be incredibly important at a future point in time.
People don't want to talk about that, but I fully agree.
UBI is probably going to be incredibly important. Now, what is the UBI? How's the UBI structured? Is it Bitcoin? Is it strategy products?
That question right there, that's what I'm getting at. When everything becomes Bitcoinized, how does everyone get exposure to it in a way that is perhaps not egalitarian, but beneficial to society? If you have all the corporations, right, and a collective group of individuals that are on the Bitcoin standard, but then everyone is on UBI on a fiat standard still, or some kind of equivalent, right?
Yeah.
It's perpetually going to go up, right? And it's a UBI, so that's technically fine. But are they going to be just at the subsistence level? They'll have all of the stuff that they need, but no more. Do you see what I mean? Like you can't elevate past it with a UBI if everything is on a Bitcoin standard. If you don't have direct access, or at least
to the
passive access to Bitcoin.
Yeah, like this. Some of the concepts in my brain go to, okay, strategy becomes the U.S. government and they are issuing the UBI products, right? Like do these pref products become UBI? Like, are these the UBI products?
Well, it's not that. I mean, if you start to game it out, it's not as crazy as you think. How many corporations hold bonds right now?
Oh, I mean, a ton.
Right. I saw a number recently. What is it, like 45%? I saw that number.
Oh, the 75% of them hold, or 75% of the bonds in the U.S. are like have an interest rate less than 5.
So we have that to consider. But in terms of the reason why I bring it up is this: what happens when even before that point, corporations start holding Strife on their balance sheet? How are these products going to scale?
Mm-hmm.
And that's long before we even get to Jeff's crazy point about strategy being the government, right? So we got a lot of years before we get to that, and there's a lot of stuff that can happen. What if Strife becomes the corporate equivalent of Bitcoin exposure from a derivative standpoint? And what if they have extra products that they're offering, right? And so on and so on and so forth. Like we use the Trojan horse example. Strategy is a Trojan horse and a TradFi, right? So what if, like what Jeff is saying, they Trojan horse everything? They Trojan horse all of TradFi with all these different offerings, and one way or another, companies have it on their balance sheet. And that's before we get to that crazy situation where we're talking about one sat is $1, and then one sat is $10, and so on and so forth.
Will Strife interest rate flip negative?
Hold up. What?
I want to hear Dan's thoughts on this too, if he's still around. He looks frozen, but
I gotta run. Thoughts on that? I really don't think so. But I have to go, guys.
Later, Dan.
Yeah, later.
We'll see you. Bye.
Yeah, this is one of the most fun things for me to think about is hyper Bitcoinization, because at that point, I think never sell your Bitcoin becomes a meaningless statement that people will remember that people said back in the day. Because if the Jeff Booth future becomes real and all of humanity is getting wealthier forever because the benefits of technology and innovation is making us all wealthier, then you only you only have to spend your Bitcoin at a slower rate than we're getting wealthier because of innovation. And it doesn't really matter that you're spending some sats, because the sats that you still have are getting so fabulously more wealthy. It becomes meaningless. And so I think
Well,
the new people that are going to be born into that world, it's really not going to be that hard to get your hands on some sats, because all of the people that will be in existence will be so wealthy that it's not going to be like now, where like, oh my God, we have to live like monks and
Tons of
stack
poverty.
every
Yeah.
little single sat that we can. There's going to be so much abundance that there's going to be more. I want to call it charity, because it's not charity. It's just an interest in sharing that wealth and investing, and even if you just get equity in what some young person is doing, they want to form a new company. Instead of charging them interest, you're just going to be like, okay, I'll take equity in the company or whatever. And there's going to be more and more investment, not less, I think.
well, in that world you're talking about, where spending sats becomes a somewhat trivial distinction, why even spend it? Why not just borrow against it? If you have an asset that's going to
Borrow
go,
Yeah, but borrow what?
borrow what?
If the unit of account is Bitcoin, nobody's going to loan you their
Borrow
Bitcoin.
oil? You
well,
borrow
this is where I
oil?
differ. I don't think the unit of account is ever going to be Bitcoin. I don't think fiat's
Hmm.
going away. Fiat's always going to exist in some form or another, is what I think. And the reason why I think that's beneficial to Bitcoin is because in this world we're talking about, where you have deflationary pressures and you have a deflationary asset, it doesn't make sense to spend it at all. It makes sense to borrow against it in perpetuity, because you borrow against it today, and in 5 years, the loan you took out, you now,
That's
do you see what I'm saying?
or you just never or you just hold the strategy instruments
Or that, I
because
mean,
they're
look,
paying you. They're
you
paying you
you
in some
you
fiat
could
like
in
medium and
you could in theory, yeah, you can have a perpetual dividend paying instrument from strategy or something to that effect, and you're living off of that dividend if you need fiat, right? Which, I mean,
let's go back to that example that I gave earlier, right? Actually, hold on. I'll just pull it up. I won't show it, but I'll talk through it. Okay, 2030. Let's just say the year's 2035. All right, based on all the math that we did earlier, the year's 2035, based on all the compound annual growth rate assumptions, all the stuff. The assets held on balance sheet for a strategy would be $3.6 trillion. And they might only have, I don't know, $600 billion of preferred stock against it. So what is that?
oh my God, that's, yeah.
That's a leverage ratio of what? 17%. What instruments are they going to be offering then?
A weekly dividend, monthly dividend,
Right, like the Bitcoin compounds so big. The amount of instruments that you can offer on such a huge capital stack is like massive, right? Like we don't know what they are yet. But
I mean, so in that event, weekly and monthly doesn't sound crazy at all.
yeah, but I guess what I'm getting at is like, yeah, you're not going to have to spend your sats, or you may just convert them. I mean, well, maybe you can buy strategies, income instruments with sats, and so you keep that exposure, maybe just in a different format that like can help you live the rest of your life. I don't know. This is getting into the realm of tail. This is tail questions. These are tail questions.
Well, there's a dozen different ways you can play it out. That's the thing.
I mean, it's so crazy.
If not more, right? So,
All right. Well, we're at 2 hours. I think we should probably wrap it.
yeah, I gotta drop myself. So yeah.
Before we get any weirder,
it's gonna get weird. Yeah. Okay. Wow. Maybe final thoughts. I will go ahead and start. I think there's a lot of things to be excited about on the horizon. I mean, you think about the size and scale of what MSTR has got here. There's no company that's even close to them. And I think it's really helpful to try to zoom out and think about like what it means to be an order of magnitude larger than another company and what that offers strategy in the future. It's helpful to use some math. If you need to go back and rewatch, what the math that we walked through earlier might be helpful. But the world of future instruments that strategy can provide here is huge. It's enormous. And the scale is going to be beyond comprehension with rationality. You're going to be able to rationalize a valuation that's so high because the market, the total addressable market of these instruments is so vastly large. So try to conceptualize large numbers. It's hard to do, but yeah, try to use some math to help you. Maybe over to you, Soleil.
Yeah, thinking about your moon math, and I didn't realize those were the moons around Jupiter because those freaking numbers are wild, and it's the future's good.
Future's bright. Adrian?
Patience, vision, resilience. As long as we have those three and we keep our wits about us, I think all of us are going to be just fine.
Absolutely.
Quite frankly.
Yeah. We're going higher. Yeah, it's going
I
up.
mean, yeah, it sounds corny. That's all I got. Because the moon math got me thinking, right? The moon math really got me thinking, and that's a silly future in a good way. If we really really sit down and think about it, that Bitcoin does what we think it's going to do, gets $100 million, right? Strategy is a company that has 700,000, 800,000 Bitcoin, and they have all these different financial instruments. It is not unrealistic to think, well, Jeff, to your UBI example, did you get your strategy check this week?
Yeah. Yeah. We'll see what it looks like. It's the U.S. government. The U.S. government is strategy.
Did you get your strats?
Your strats. Oh yeah, your strat check.
I'm just saying, this sounds weird, but we are a capitalistic society. So is it outside the realm of reason that a capitalistic, like a capital-driven company that lifts and shifts itself into the middle of this financial system has this asset and grows so huge that we use capitalism as a form of subsisted UBI, at least partially, and people are walking around saying, "Did you get your strats?"
Stacking strats.
There it is.
Tell me that's not some Blade Runner,
stacking strats.
Fucking crazy.
Maybe that's the future. Right? Maybe that's the future. 2049. Maybe we're all stacking strats and you got a UBI paycheck on a preferred instrument from Strategy's $25 trillion balance sheet.
The good news is we're all living in the future.
Yeah, we're all alive. Yeah, we're all cooking.
Yeah, we don't need a time travel to do it either. So yeah, it's good.
Exactly.
All right, guys, that is a wrap. We got 9,990 people. Thanks for listening, and we will catch you next week.
Thanks, everybody.
Later.